Investment markets rallied in recent weeks as global central banks emphasised that interest rates would remain low for a considerable time, even if the level of asset purchases under QE3 in the US is reduced later this year. In early July, both the ECB and Bank of England highlighted that concerns over higher interest rates caused by speculation over tapering of QE3 were unwarranted, with the ECB taking the unprecedented step of providing forward guidance when saying interest rates would remain at present or lower levels for an extended period. In the UK, the Bank of England similarly guided towards rates remaining low for a long time when saying that the existing slack in the economy would persist for some time, and also indicated it would provide more details regarding future forward guidance on interest rates in August. In the US, the Fed Chairman, Ben Bernanke, sought to separate any decision on tapering of QE3 from actual interest rate rises by saying that highly accommodative monetary policy continued to be required for the foreseeable future. It was emphasised that, as previously indicated, interest rates were unlikely to rise until 2015. If anything, Fed official commentary through the month became more dovish as the minutes from the Fed meeting of 31st of July highlighted the risks to the economy of persistent low inflation and the possible restraint on growth from the recent rise in mortgage rates, while the assessment of recent growth was downgraded slightly as it was described as being modest. Recent economic data has showed continued modest improvement in the global economy, driven by developed economies, coinciding with slowing momentum in emerging economies. The main positive development over the last few weeks has been the improvement in sentiment indicators for Europe, many of which are at 18 to 24-month highs. One of the most widely followed indicators is the Purchasing Managers' Index, or PMI, which is a monthly survey of private sector companies across the globe, and which asks corporates what the outlook is for their business. Readings above 50 indicate expansion, while below 50 indicate contraction. This chart shows that for the first time in 18 months, the Eurozone PMI has moved back above 50, suggesting it is about to exit recession with modest positive growth likely in the second half. Similarly, the global composite PMI is well in expansionary territory and is at a 16-month high. These and other recent data points suggest that the global economy will maintain an upward momentum in the medium term. Equity markets rose 4.5% in local currency terms in July and are up over 17% year to date. While debate continues over the exact timing of the beginning of tapering of QE3, the market now appears to have discounted the likelihood that will begin before year end. Equities remain underpinned by valuations, particularly relative to other asset classes, improving fundamentals as reflected in the modestly improving global economic backdrop, and the fact that they remain relatively under-owned. Given these supports, we believe equities continue to offer upside. Eurozone bonds gained 0.9% in July due to the commitment by the ECB to keep interest rates low for longer. Core global bond yields have nudged marginally higher in August to date on the better economic data. By year end, yields could continue to move slightly higher as growth continues to improve and the reduction of bond purchases under QE3 actually begins. Thereafter, low global inflation could keep bond yields stable.